Now we come to the next topic. How does a stock price move up and down, and how does trading actually occur? So now that we know what an IPO is and where stocks come from, we are going to get into how and why stock prices go up and down. Another term for stock prices going up and down is called price action. Price action is the term many traders use when they are describing the movement of the stock price in the upside or the downside direction. Two more terms that I want you guys to learn are a bull move is when a stock price moves up aggressively or quickly, and a bear move is when a stock price moves down aggressively or quickly. Now that we have the terms out of the way, we can look into what exactly causes the prices to change in real time. First, let's tackle some of the misconceptions that people have regarding price action. Myth number one. A lot of people assume that stock prices are directly affected by profits and losses of a company. And myth number two is that people assume that stock prices are directly affected by changes in the company's management. For example, a new CEO being appointed. At this point, you must be thinking, everything I thought about the stock market is a lie. Remember, the keyword is directly. The stock price is never directly impacted by the things such as profit and loss and changes in management. The stock price is indirectly affected by these factors. And so you must be asking, how exactly is the stock price indirectly affected? And the answer is psychology. The price of the stock goes up and down based on what the traders and investors think it's worth. And now you're probably thinking I'm crazy. How can a price change because of how someone thinks it's worth? That's exactly what I will explain to you guys now. Let us go back to the example in the previous video. If you recall, Adrian's Bakery stock price is at $50 and he is trying to raise $5 million. Eventually, traders will buy up all 100,000 shares of that money, and that money will go to the business owner. That $5 million went from the investors who exchanged their money for stocks to the business or company. And for the duration of the life of that stock, however long the company remains public, the stock will also remain. Now, before we proceed, there are a few definitions that we need to cover. First, we have the online broker, which is a website that allows the buying and selling of securities. Next, we have the sell limit order, which is a type of sell order which allows for the seller to determine the exact price that they want to sell the shares. And finally, the buy limit order, which is a type of buy order which allows for the buyers to determine the exact price that they want to buy the share. We will cover the different type of buy and sell orders along with a more detailed explanation of online brokerage in the next video. But for now, let us continue. The act of a trade in the investing world is basically when a stock goes from person A to person B. So say one investor, whose name is Jimmy, purchased 100 shares of Adrian's Bakery. He purchased those shares at $50 per share, so he spent $5,000 total. Of course, he wants to make a profit, so he decides to sell every single one of his shares at $51 each. And $51 times 100 is $5,100, giving him a profit of $100. But in order to make that money, he would have to convert his shares into cash by exchanging the shares for US dollars. So Jimmy would then have to put a sell limit order at $51 and wait. Then the buyer comes along, whose name is Lisa. Lisa was doing research online and came across an article in the local town's newspaper and read about the success and expansion of Adrian's Bakery, and she decides she wants to invest in that company. So she gets online on an online broker and puts a buy limit order at $51. Instantly, through the online brokerage website, the transaction is made and 100 shares of Adrian's Bakery goes into Lisa's account. Due to this trade, the new price of Adrian's Bakery has increased to $51 from $50. Thus, price action has occurred. Now that Lisa has acquired 100 shares of Adrian's Bakery for $5,100, she of course wants to make a profit. So she now decides to sell her shares for $55 each. She then puts a sell limit order at $55 and waits. The next day, there is another news article about Adrian's Bakery. In the news article, it explains how a customer reported finding a dead fly in one of the cakes purchased. As a result, health inspectors are re-inspecting the bakery for hygiene and cleanliness. After the article gets out, people are no longer interested in buying shares of Adrian's Bakery. After waiting, investors like Lisa cannot find anyone to buy their shares. Lisa decides that investing in the company is not a good idea, since the reputation is going down. So she decides to sell her shares at $48 instead of $55 out of fear that eventually no one will want to buy her shares and it will be a total loss for her. So she then puts a sell limit order at $48. Then Jimmy, who is confident in Adrian's bakery, since he already made a profit, buys Lisa's shares at $48 despite the negative article. The price has now gone from $52 to $48. Price action has once again occurred. This is how psychology indirectly affects stock price. Now let us consider the question, what if Jimmy also worried that Adrian's bakery has lost their reputation for good and there's no buyers at even $48? Lisa would then lower her asking price even more. She may put her order at $40. Her loss would then be $10 per share, and since she has 100 shares, her loss would be $1,000. Similarly, if the very next day there is another article that comes out with positive news, the stock price could go up to $70, and anyone who purchased their shares at $40 and then sold at $70 would have a profit of $30 per share. At 100 shares, that's a $3,000 profit. I think you guys are starting to see the full picture now. This is how human psychology, influenced by the news, media, and current events, can cause price action. In its core, this is how stock prices go up and down. In reality, there aren't just Jimmy and Lisa, but thousands of investors and traders. Trades for a certain stock can happen multiple times per second. It all depends on what sort of stock you're in. The stocks of more popular companies are traded more quickly, and companies that are not as popular may be traded more slowly. I hope you guys are now better able to understand price action. In the next video, we will go more in depth into the different type of trades of online brokers and discuss what sort of fees there are. See you guys in the next video.